Hello, ladies and gentlemen. Welcome back to our lecture on investment appraisal, and we are going to continue from where we left. Okay, I am your Acca tutor, Mr. Jeremy Tim Kulu, and those are the numbers you can use to contact me on the header there on the screen. All right. Previously, we looked at the working capital issues as they relate to the net present value computations, and then we also moved on to taxation, and we showed you how you have to deal with taxation, and we pinpointed that taxation affects two types of cash flows: the operating cash flows, where it affects the income from the normal sales from the project. Okay, then we also looked at the issues related to capital allowances, where we say that there is some benefit. Okay, there is some benefit in terms of cost savings if we ended up, buying a new machinery, and we are given some tax allowable depreciation by the taxman. So we will be recovering some form of um, cash flows. All right. Now we need then to consider another aspect in our investment appraisal, that is inflation. In reality, we are operating in an inflationary environment. In most countries, the rate of inflation is always going to be a pain on the neck to investors. So we need to consider inflation, the impact of inflation. That is, inflation is just the continuous increase in prices of commodities or services. So we just need to put that inflation in our computations. All right. So for our discounted cash flow techniques, calculations, we need to discount the actual forecasted, actual forecasted cash flows, and therefore it is necessary for us to do the arithmetical inflating of the cash flows by the rate of inflation in order to complete our cash flow tables. So with this particular example, Ngedwa, we are going to go through the process of inflating, and you guys have to pay attention, because this is where students find it impossible to pass this paper, because the way they do the inflation, the process of inflating, they end up mixing up things, and by the end of the day they fail. So please pay good attention as I go through the example. All right, Ngedwa Limited are considering buying a new machine in order to produce a new product. The machine will cost 2.8 million and is expected to last for 3 years, at which time it will have an estimated scrap value of $1 million. They expect to produce 100,000 units per annum of the new product, which will be sold for $20 per unit in the first year. Production cost per unit at current prices are as follows: materials $8 per unit, labor $7. So you can see the total cost there. The total prime cost per unit is almost like $15. All right. Now we are told that materials are expected to inflate at 8% per annum, and labor is expected to inflate at 5% per annum. Fixed overheads of the company currently amount to $1 million. The management accountant has decided that 20% of these should be absorbed into the new product. The company expects to be able to increase the selling price of the product by 7% per annum. An additional $200,000 of working capital will be required at the start of the project. Capital allowances 25%, reducing balance, tax 25%, 1 year in arrears, cost of capital 10%. Now we need to calculate the NPV of the project and advise as to whether or not the project should be accepted. So as usual, let us start with our capital allowances computation. So let us go straight to our spreadsheet. Okay, let's open a new one. Okay, let's just say capital allowances. My spelling for capital there. Calculations. Okay. Now, this is a 3-year project. So we start with our year 1. Okay. Let's talk of the cost of the assets. The cost was 2.8 million, if I'm not mistaken. That's all right. So everything should be all right. All right. So this should be just 2.8 because everything we've put all the monies there in dollar thousands. All right. And then let's talk of the tax savings. Tax savings. Okay, again, these ones are also in dollar thousands. Okay. Now, right, you can just broaden the cell to ensure the figures are clearly visible. Okay, and so the cost, and then we are told that the capital allowance is just 25%, reducing, so that's at 25%, reducing balance. And what is 25% of 2.8? That's 0.25 multiplied by 2,800. So this is 700,000. So that's the depreciation we are allowed to go away with. So we then have to say multiplied by the tax rate. Our tax rate is also 25%. So multiply by 25% so that the examiners will see. Okay, but even if you don't do that, and just, since you are in Excel, even if you don't type that, the examiner is going to see with your formula here. So this should be 700, got 700 multiplied by 0.25. So we're going to have $175,000 as our tax benefit. Okay, then we continue these sides. Let us try to underline. All right, let's proceed to the NPV. 2.8 minus 700, we come to 2.1. Okay, 2.1. All right, and then we say in year 2, all right, the year 2 figure, the capital allowance on 2.1 there. Okay, we are going to say 25%. Okay, 0.25 multiplied by this figure, we get 525 multiplied by 25%. Okay, and you can see this should be 0.25 multiplied by 525, and we have got our 131,250. Okay, we underline these parts. Okay, sorry, don't like this underlining. Let us use this one. Okay, the borders are a bit effective. As you can see, they are neat. Okay, so what is the new balance there? That's equal sign this figure minus this figure. We get our 1,575,000. Okay, well, that's 1,575,000. Okay, now we know that the project is going to end in year 3, and we have to then worry about the about whether there is an proceeds any scrapped value. Okay, so yeah, 3, we're going to dispose this, and we have got proceeds from disposal, and we are going to dispose this machinery 1 million. Okay, so obviously we are going to have some balance here. Once again, I made that error again. I don't like this type of underlining. I want this one. Okay, so we are left there with our 575,000. So our capital allowances are going to be claimed on this balance. Okay. Okay. All right. But now, one thing I want you to understand, as we did in the previous video, here, all right, this is the balance we are left with. All right, so we are only going to claim on this balance, we're going only to claim the tax savings. All right, so we are not going to subject this balance to a capital allowance claim. All right, we just assume that the whole balance is just the capital allowance available. Okay, we're not going to say 25% multiplied by this one. No, we're just going to take the 100% of the balance, okay, as our capital allowance. All right, so we are going to claim everything that is left on this balance. So as usual, we multiply by the tax rate, and the balance now is going to be, okay, the balance now is going to be okay, that's 0.25 multiplied by this amount. Okay, so we get 143,750. Okay, now since the tax is payable 1 year in arrears, you then have to come here. Okay, you can come here and say year affected. Obviously, this one is going to affect year 2. Okay, you can just say year 2. All right, this one year 3. Year 3. Year 4. Okay, so that you won't confuse yourself in the Npv table. All right, so we come here and do our Npv tabulation. So that's the cash flow, the cash flows. We start with the years. Our first row, you can skip a line for presentation purposes. Years, year 0, year 1, year 2, year 3, year 4. Okay, and you can as well put everything in dollars, dollar thousands. All right, dollar thousands, so that your examiners will see clearly what you are doing. Sorry. Okay, now we start with the operating cash flows. All right, this includes the revenue. All right, now For the revenue, we just need to be a bit careful. Okay, if you look at the question here, you can see that the revenue is dependent upon the rate of inflation as well as the quantities of units produced. Okay, so my machine now. All right, so you can see here the expected, they expect to produce 100,000 units per annum. All right, and they also expect to charge, to increase the selling price of the product by 7% per annum. So there is an issue of inflation to be considered, as well as the issue of quantities produced, and the selling price per unit is $20 per unit. All right. So since we are in Excel, we can do everything on it in Excel. The cell should actually be able to tell us the information we need. Okay, so we know that they are producing 100,000 units. All right, multiply by the price per unit, selling price per unit, and that's 20. Okay, that's year one. All right, so we expect to see $2,000. Okay, and after year one, they will increase this amount by 7%. Okay, they will increase by 7%. So we are going to say this amount, equal sign, this amount, all right, multiply by 1.07. Okay, so what's going on here? Right, that's 2,140, and the next figure here is also going to be based. Just have to multiply this one by 1.07. Okay. All right. And then this other figure is also based on this one, multiplied by 1.07. But remember, this is a 3-year project, so therefore we are no longer we are no longer having any revenue in the 4th year. All right. So the 4th year, I've only added it for the taxation, which is payable in 1 year in arrears. All right. Let us try to format a bit so that we see which one is what. Okay, remember we are talking of the cash flows. All right, now the revenues, we are done. In this case, I want you to know, somebody might be asked, confused as to say, why didn't you inflate year one figure? We are specifically told in the question that they expect to charge $20 per unit in the 1st year. All right, so automatically they have considered that $20 is fine. All right, they've considered $20 is fine, but after year one, we then have to start inflating our figures. All right, let's move on to the costs. All right, materials. Let's start with materials. The materials are going to be based again on the quantities produced, and we are saying we are producing 100,000 multiplied by the material cost per unit, which is $8, multiply by an amount that is chargeable to inflation, depending on the all right. Materials are expected to inflate at 8% per annum, and labor is expected to inflate at 5% per annum. All right. All right. Okay. Now, as the materials and labor costs are expected to be inflated at 8% and 5% respectively, and that the examiner or the example is not showing when the inflation or the inflating has to be started from, then we expect that we are going to inflate starting from year one. Unlike in the revenue case, we are told that they expect to charge, okay, they expect to sell the product at $20 per unit in the first year. The question is specifically told us that in the first year we are going to charge $20. So this is the difference. The costs are unclear, so in that case you have to start your inflating from year one. So the materials are going to be inflated at 8% per year. So let us inflate the figures. Multiply by 1.08. That's 864. Then equal sign this figure multiplied by 1.08. That's 933. Okay, here equal sign this figure multiplied by 1.08. We get that figure. We move on to the labor. Okay, the labor is also charged per unit, and we are expecting to produce 100,000 units. So multiply by the labor cost per unit was 7. Okay, multiply by 1.05 because the inflation rate is 5% for labor. So that's we have 735. Okay, one thing I want you to appreciate is that these are costs. All right, these are costs. So we then have to make them into negative. All right, they should be negative figures. All right, so we can say multiply by minus 1. All right, everything has become minus 1, which is fantastic. And here we can as well multiply this figure by minus 1 to ensure the figure is negative, because they have to be negative, their costs. All right, and then this one is based on this figure multiplied by 1.05. Okay, and this one is equal to this figure multiplied by 1.05. Okay, and then we can move on to our totals. Okay, we can just total up and we get our total operating cash flows. let's total up or operating cash flows before taxation. All right, this one is sum, right, up to here. Okay, and you can just drag. Okay, you can drag up to this point. All right, you get those figures. Now, once you get those figures, you then have to say tax on operating on operations or operating cash flows. All right. Let's widen up. Okay. So we know that the tax rate is 25%. Tax rate is 25%, but the tax is paid 1 year in arrears, so we are starting year 2. Okay, so equal sign 0.25, that is 25%, multiplied by cash flows in year 1. Okay, and then let's drag everything. Okay, we are done. These items shouldn't be in bold. Okay, the bolding was only for selected pieces. All right. Now, so those were the these were the taxes. Okay, and these taxes are in outflow. Okay, these ones are in outflow because they have to be remitted to tax authorities. So we can just as well multiply these cash flows by -1. Okay. Okay. All right. Now we then have to move on to the cost of the equipment, the cost or initial investment. The equipment was for 2.8. Okay, all right, 2,800. That was the cost of the equipment, but remember it's negative, so 2,800 negative. All right, and then here you can also think of the scrap value. The scrap value is going to be 1 million, and this is going to happen in year 3. All right, and then we have to think of the tax allowable depreciation. Okay, the tax allowable depreciation, the TAD. Okay, let us just use tax savings on capital allowances. Okay, you can refer to working number 1. You should have so you can say here working number 1. Okay, working 1. Right, but it is good practice to clearly designate your working area so that examiners won't struggle to locate your workings. Right. All right, we know that the tax is going to be remitted starting from 1 year is in arrears, so that is starting from year 2. So we start to slot in the figures, and these are the figures. So we pick this figure first, 175, and slot it under the column for year 2, 175. We pick another one that follows, that is in year 3, that was 131. You can just copy and paste this figure and slot it here. pick again this one and slot it here. Okay, what's going on? It's refusing to come. Okay, 143.75. All right. Now, once we do this, we then have to okay. Okay, let's think of the working capital. Working capital. Okay, or WC. The working capital. The question is saying is required at the beginning of the year. Okay, an additional $200,000 of working capital will be required at the start of the project. So obviously, we are going to consider the outflow of 200,000 in year 0. So that's negative 200, and we expect to recover it in year 3 at the end of the product. So positive 200. Okay, and I'm sure all the cash flows have been considered. So let us then underline our table. Where is my perfect underliner? All right, so these are the net cash flows. Okay, so here, let's sum up. We get how much? Negative 3,000. Okay, here we have got 401. All right, here that's because side sum. Let's sum up everything, get that one. Let's try to just fill up everything. Okay, we are done. Then we do our discounting. Discounts factor at 10%. We are told that the discounts, in this case, the cost of capital was 10%. So that's what we're gonna do. And always in year 0, we're going to have a discount factor of 1. Then other years, that's 1 divided by 1.1 to the power 1. Sorry, I didn't put an equal sign. Excuse me for that. 1 divided by 1.1 to the power 1. You get that amount. Here, that's 1 equal sign 1 over 1.1 to the power 2. That's that much. Then here again 1 over 1.1 to the power 3. That much. And here 1 over 1.1 to the power 4. We get that much. Okay, let's underline. Right, and we come to what are called PVs, present values. Present values. Okay, and equal sign this one multiplied by that one. Negative 3,000. Let's drag everything. That's the benefit of the Excel. Okay, now, ladies and gentlemen, we have arrived at the easier bits. Okay, we now know the present value, so the NPV is now simple to get. So NPV would be equal sign sum, start from here to here. That's a negative 923,578. So therefore, you need to reject the project because it has got a negative NPV. Okay. Okay, we can just try to do a little bit of rounding, formatting, so that examiners could see our answer with easy. Okay, let us try. The NPV should be clearly seen. You can as well put these figures, we can make them center justified, yes, like that, and we can as well try to make the decimals, these decimals can be reduced, that they just become whole numbers. Okay, that's great, and the NPV as well should be of the same fashion. Good. So there, ladies and gentlemen, we are done with this presentation, and before I go, there is another example I hope we will benefit with regards to this inflation. Let's talk of the Fisher formula. All right, we have discovered, or we have actually done the ideal way of accounting for inflation in net present values or in investment appraisal. However, sometimes we are only given or we are only told that the rate of inflation is going to be the same throughout. Here you discover that the sales price was having its own inflation rate, the materials and labor likewise were having their own. But very occasionally you might be presented with the situation where all flows are expected to inflate at the same rate of inflation. In this circumstance, you can still use the method we have already discussed, but alternatively, there is a shortcut approach that can save time. Instead of having to inflate each flow using the rate of inflation and then having to discount each at the cost of capital, the same result can be achieved by discounting the current price flows, okay, or the real cash flows at an effective or real cost of capital. All right, so the effective cost of capital is calculated using the formula, okay, 1 plus, you know the Fisher formula, right? Okay, the 1 plus I in bracket is equal to open bracket 1 plus R close bracket multiplied by open bracket 1 plus H close bracket, where I is the actual cost of capital or the nominal rate, okay, and R is equal to the real cost of capital and H the general inflation rate. Remember, this formula is going to be given to you in the exam, so no need to stress out. So let us try this example and see what we can get out of the presentation. Sorry, my machine seems like it is now overheating. I guess it's not going to take much of your time before it recovers. Okay, now, yes, this is the example, ladies and gentlemen. A new machine will cost 120,000 and is expected to last 3 years with no scrap value. It is expected that production will be 10,000 units per annum. The selling price is $20 per unit, and the variable production cost $14 per unit, both quoted in current prices. Inflation is expected to be 5% per annum, and the cost of capital is 15% per annum. Calculate the net present value of the project. A. Inflating each flow to get the nominal cash flows and discounting at the nominal cost of capital. B. Discounts the real current price flows at the real cost of capital. And tell us why, in theory, will the decision remain the same whatever the actual rate of inflation turns out to be. So let's attack A. Okay, let us inflate each flow to get the nominal cash flows and discount at the nominal cost of capital. Okay, so let us get to our Excel spreadsheet and see what we can do. All right, so you can say part A. Your part A, let's have a table. Okay, can have a table where we say this is year one, the year column, all right, and the current prices. Okay, and all right, and we have got the cash flows. All right, cash flows. Right, cash flows, and we have the discount factor at how much? We are told the cost of capital is 15%. You can use tables, but I've already shown you how to calculate these discount factors, so it mustn't be a worry. By the end of this video, you should be an ace in calculating those discount factors. Okay, so we've got year 0, year 1, year 2, year 3, year 4. All right. Now, in year 0, that's when we procure the equipment, and we are told that the equipment will cost 120,000 and is expected to be there for 3 years. All right, which is good and nice to hear. All right, so in this case, the tax issues have been ignored. All right, the tax issues have been ignored, so our year 4 should be deleted. We don't need year 4, but we might need another year there. All right, we'll reach there, don't worry. So that's 120,000. Okay, negative 20,000. That's our first year. All right, and this simply comes as it is 120,000, and the discount factor is 1, and the PV would be this much. So sorry, equal sign this multiplied by that. Okay, now that was in year 0 today. What about in year 1? Okay, in year 1 we are told that there are going to be cash inflows. Okay, the selling price is $20 per unit. Okay, selling price is $20 per unit. And the variable cost of production are $14 per unit, but we are only given the inflation rate of 5%. Okay, the total inflation rate. So everything, the selling price and the production, the variable cost of production are going to be inflated at the same rate of 5%. So in this case, it is sensible to just know the operating cash flow, the net operating cash flow, which is the $20 minus 14, the profit which we are going to get. So that's 20. Okay, you can just say operating profits on your workings. Number one, operating profit. Okay, is equal to $20 minus $14, which is equal to $6 per unit. Now the examiners can easily see that you know what you are doing. Then you come here and say, because we are producing how many? We are producing 10,000 units per annum. So the current price should be equal sign 10,000 multiplied by $6. So 60,000. However, this value has to be the value has to be inflated. Okay, so we have to inflate it by 5%. So we are going to say multiply by 1.05. Okay, and we get how much? This is what equal sign 60,000 multiplied by 1.05. Like I said, in the exam there is no need. Okay, in the exam there is no need for you to type 60,000 multiplied by this, multiplied by 1.05. We don't need to see it, because when we click at your formula there in this particular cell, when we click here, we'll see that on the formula bar there, we can see that we have inputted a formula. So the typing, you won't have that time to type things. All right. In year two, we are also going to have 60,000, because the production is going to be 10,000 multiplied by the profit of $6. So we are also going to have, so you can just copy. Oh, what's going on with this? Oh my God. Okay, it's fine. It's misbehaving. 60,000. Okay, then here it's just 1.05, but this time is to the power 2, because it's now in the second year. All right, so that's to the power 2. Okay, that's what will be happening. So that's 60,000 multiplied by 1.05 to the power 2. So I didn't put the equal sign. All right, that's the value we get. All right, and then we move on here. We say 1.05 to the power 3. We come here and say 60,000, equal sign 60,000 multiplied by 1.05 to the power 3. We get our 69,457. We then have to discount this using the appropriate discount factors. So at 15%, we're going to say 1 equal sign 1 over 1.15. Okay, in here 1 to the power 1, right? Here we just say to the power 1, it's just the same. Get that? All right. Here that's equal sign 1 over 1.15 to the power 2. All right. And here that's equal sign 1 over 1.15 to the power 3. You can just cross-check your formulas on the formula bar on top here and see if you have inputted all the figures correctly in your formula. All right. Then after you do that, I'm sure you can simply drag and you see you are done. Okay, you are done. All right, and then for your NPV, all right, the NPV is equal to sum this much and add up all these ones, and you get your 30,470. Okay, 40,470. That's a positive, and in this case you have to accept the project. Now what about if we want to discount the real or current price flows at the real cost of capital? All right, so in this case we have to rearrange our formula, the features formula. We have to rearrange our formula. Okay, so that's part B. Our normal formula is the Fisher formula. Let me just say Fisher formula. Is 1 plus I, okay, is equal to 1 plus 1 plus R multiplied by 1 plus H. That's the normal Fisher formula. All right, and we all have to be comfortable with that formula. Now we want to discount the cash flows using the real rate of inflation. I mean, using a real flows. Okay, the real rate of inflation rather. All right, so using the real cost of capital. So what we are going to do is we then have to rearrange the equation to make R subject of the formula. So given this equation, you can see that at first we have okay, when we rearrange it, it becomes 1 plus R, 1 plus R. It's gonna be equal to 1 plus I, okay, over 1, sorry, open bracket 1 plus h. Okay. All right. So in this case, in this particular case, so let's try to put in the variables. Okay, the equation becomes 1 plus r is equal to, we know that the cost of capital, the nominal cost of capital was 15% from the question. Okay, the cost of capital there given was 15%. So that's 1 plus 15%, that is 1.15. Okay, divided by the rate of inflation h. The rate of inflation h, the general rate of inflation was 5%. So divided by 1 plus 5%, that's 1.05. Okay, so 1 plus r, 1 plus r is equal to you can do the workings here, 1 over 1.5, I mean 1.15 over 1.05. That's 1 point. Okay, just copy this and paste. All right. Can just sorry, try copy it here. Okay, that's the amount. So therefore r is equal to 1, I mean equal sign this minus 1, so 0.09523. So r is equal to approximately 9.52%. R is got 9.52%. All right. So let us try to see what's going on. All right. We can simply say which is approximately 10%. Okay, 9.52 is approximately 10%. Okay, so let us try to come up with a discount table where we will be using the 10% discount. Right. So we come here, say our year. Okay, our years, and our current prices. Okay, and the discount factor. Okay, discount factor at 10%. because we are now using 10%. All right, and what are going to be our PVs? All right, okay. What's going on? Sorry. Sorry there. What's going on? It's refusing to type. Okay, so it means it doesn't want this. All right, 10%. It's fine. I don't like this. I want what I want, so I keep on trouble it. I keep on trouble it. All right. All right. I'm sorry for your time, guys, but all right. Sometimes the machine sticks. I'm sorry for that. All right. Okay. All right. It's looking perfectly now. It's looking perfect. Okay, so we've got in year 0 we've got our investments in machinery, the new machine, and we are told in the question that the investment was 120,000. The discount factor for year 0 is just that 1. Okay, and then this one is going to be this. Okay, multiply by the discount factor. Okay, since we are using the same rate, okay, we are using the same rate of inflation, so we'll be using our some annuity. Okay, we'll be using annuity table. We are having constant cash flow, and we are also having the same rate to be used. So in this case, we just have to run an annuity computation. So discount factor year 1, sorry, this Excel, year 1 to year 3. Good. Year 1 to year 3. All right. Year 1 to year 3, and we are receiving 60,000. All right. So in this case, because the inflation factor has already been put in our discount rate, so what happens is we are simply going to just make, to do an annuity computation. So we go to the annuity tables and determine what this what the annuity factor would be at 10% 3 years. So if we go to the annuity tables, we should get that. So let me try to see if we still have our annuity tables here. I'm sorry for that. Okay, ladies and gentlemen, here is the annuity table we are talking about. Okay, you can as well, if you do, you can as well try to use the formula, as given there is encircled in the, by the red, by the black pen here. That's the annuity formula, but you can as well use tables. So we want to locate 10% at 3 years, 10% 3 years annuity. So you can see that the annuity factor is 2.487. Okay, the annuity factor would be 2.487. So you take that figure, come with it here, 2.487. Okay, but before you close your books, you need to consider if there is any scrap value, and you can see that there is no scrap value from the facts in the question. Or let me try again to locate the question. So the scrap value is 0. So in that case, we can close our books and say for this one here is that much. Okay, that's 149,200. Then we get our NPV, as simple as that. The NPV is going to be, NPV is the sum of the initial investment, of the PV of initial investment and PV of cash inflows, and we get this much. So let us try to do some formatting. Okay, and we can use the underlines. Here again, let us underline. Oh, sorry, that's not the underline we want. Now that we have done that, we can then safely say, all right, we can safely say that if we go by the nominal cost of capital route, we are going to get this much. Okay, gives me we get this much. Okay, if we go the real cost of capital route, we get this much. It's almost the same, as you can see. Okay, it's almost the same. The idea is, okay, remember this figure which I have used as my discount factor. The annuity factor is in a simplified form. It has been subject to rounding. Okay, there's been some rounding issues that have taken place. All right. So you can also appreciate that the higher the discount rate, the lower the NPV. Okay, the actual discount rate we should have used is 9.52. All right, but because I was lazy, I didn't want to do the computations, and I ended up rounding up to 10%, and that reduced my NPV from as far as 30,470 to 29,220. So there are two factors that have affected me: the rounding of the figure itself, the discount factor, as well as the rounding up of the discount rate from 9.52% to 10%. That impacted me on my NPV. But by the end of the day, you can appreciate that using the nominal cost of capital or the real cost of capital, you arrive at the same rate. This is because we have factored in the inflation in the real rate. Real cost of capital. We would have factored in the discount rate. Okay, so that is it, ladies and gentlemen. With practice, I want you also to look. To look in the next video where we'll be elaborating on the other aspects related to the investment appraisal. We'll be looking at the make or buy decisions, the equivalent annual cost, as well as a comprehensive exam, past exam question. We are going to look at a comprehensive past exam question. So please flow with me, just be with me so that we flow together. All right. Until next time, ladies and gentlemen, may you continue to feel very, very excited. I am signing out.